Hi, welcome to Get Person with Finance. Today I have another question and it reads, what's a good time to get life insurance and what's the best? So you probably know my response to this, and it's not a straightforward one because it all depends. When it comes to your personal finance, life insurance is a financial product. It's part of the insurance category, and that category of insurance, if I can break it down in a financial plan, is the 50% half that deals with your foundation. It's protection, right? It's protecting your wealth. It's protecting if something were to happen to you, right, for various reasons. But in this case, when it comes to life insurance, it's death. And then the other half is growing your wealth, and that's the investment part. So insurance products like life insurance, I have a long relationship because when I first started in the industry in 2005, the first license I ever got was a life insurance license. And then and a couple months later, I got my securities license as well too. But the company that I was affiliated with when I first started, they were really big on life insurance to the point where they thought life insurance can do everything. And and obviously a good salesperson would make that type of pitch, right? That life insurance is like everything, right? Again, there's a fit for it. Think of your finances as your financial plan as break into puzzle pieces, right? It's just a puzzle piece in your financial plan. So with that being said though, when's a good time to get life insurance is when you start to care about, when you start to have responsibilities. So for example, let's just say I just started off in my 20s. I take care of my parents. I have all these financial responsibilities, especially taking care of my parents. So if something were to happen to me, if I were to pass away prematurely, then what happens to my income? It dies with me, obviously. It stops. So life insurance steps in to then replace my income to continue to take care of my parents. And if I have a mortgage to pay off the mortgage, right? So I don't leave this debt and responsibility to my loved ones. So I don't have to relocate to another neighborhood. So I brought up one example, that's to replace my income. The other one is my mortgage. And if I have debt, if I have credit card debt, a lot of it or whatever, obviously I need to make sure I have enough life insurance if something were to happen to me, that again, all of my financial responsibilities are covered. The insurance company will step in and basically take care of those things. And so the amount of life insurance you need depends, right? Again, it all depends on who you are. So I don't understand how some of these people can answer these questions just point blank. It's really strange to me. I guess if you're talking to a planner that looks at everything comprehensively, again, it all depends. So the rule of thumb generally is you take your income and you multiply that by 10, right? This is just one of many rules of thumb, but this is a common one. So let's say you make $100,000 a year, you need $1 million. 100,000 times 10 is $1 million. So if I were to pass away, my parents would receive $100,000 that depends on my income. And if I can invest that $100,000 at, let's say, a 5% rate of return, that's $50,000 a year that would come in and pay for the mortgage, to pay for some of the basic expenses. I would leave behind $1 million. And let's say that gets invested at something fairly safe at 5%. 5% of $1 million would be $50,000. So there's $50,000 of income coming in to pay for a lot of the expenses that I would pay for if I was still alive, right? So that's one. And then maybe some extra money to pay for some debts and things like that. So that's one rule of thumb. Obviously, the more you can get, if you account for, let's say if you have kids, then you want to leave money behind for their college fund, then that number adds up, right? So that's a discussion you need to have with your own financial professional. But this is good for you to think about. And there are plenty of resources out there to help you figure out how much you would need. But the other thing is, in reality, get as what you can afford. I think anything is better than nothing, especially when you have financial responsibilities, right? But let's say you don't have any at all. What's the need for life insurance? Because when you die, all the debt dies with you and nobody really is going to inherit your debt or nobody's going to be dependent on your income. You don't need it. So, and so on the subject of what's best, I mean, to answer that question simply, there are two types of life insurance to break it down simply. There's term and there's term, and then there's the cash value permanent type. So they really fit under two categories. So term insurance is generally, if you work for an employer, they would generally offer you something like term insurance for the term of your employment, like a policy that's like from 10,000 to 50,000, or as much as like, I don't know, 3 times, 5 times your salary. There's many options, but it's generally for the term of your employment. And then the other type is the permanent type, where if you were to pay a certain amount, then the policy would be guaranteed to age 100, it would be guaranteed to age 70. You know, you can design it how you want, so you can have the discussion and ask. So on the subject of permanent insurance, there's 2 types of permanent insurance, really. There's the universal life insurance policies, and then there's the whole life policy. So whole life was invented first, and then later on the newest version is universal life. So whole life, the company pays a dividend and your cost of insurance is level. So that's why generally whole life policies are more expensive. Universal life policy, where your cost of insurance goes up over time. So it kind of goes like this, where whole life, it's this, it's flat. So again, they're different products similar to like a car, right? Now they have cars that are obviously gas powered cars. They have the hybrid cars, and then they have the plug-in hybrid, and then there's all electric, right? So for example, like they have UL policies where universal life policy, and then their whole life, right? But universal life policy, there's index universal life, there's variable universal life, there's guaranteed universal life, right? So it really depends on your need. And so again, it's hard to say which one is better. It depends on your design, right? And so if your design for the policy is to generate a lot of cash value inside of it, then your design is going to be a lot different. But if your design is to pay for 5 years, 10 years, and then 15 years, then it's done, it's guaranteed to be paid towards age 100, age 120, then it's different. So be mindful that, again, what car you're designing. Are you designing a sports car where you just want to go fast? Or are you designing a car that's like a Lincoln Town Car that's just a good sedan, that's comforting, good drive, it's not meant for off-roading? So you have to be very conscious of that, and a professional will really break those things down for you, especially like someone who's independent because they represent so many different companies. And I think the important part is ask them, what life insurance do you have specifically, and why do you have that policy? And for yourself, and then for your spouse, and for your family, right? Really important, because that simple question that you just ask them will really give you a good idea of where they're coming from, and it gives you a good idea of like their thought process, and you learn from their decision making. So life insurance is one of those topics where when you work with a financial professional, or investment for that matter, always ask them. It's a very simple question that, hey, what do you have, right? What investments do you have? What financial product or what specific insurance you have, and why? That is really telling. And obviously you want to work with a financial professional that obviously practice what they preach. It'd be really strange if you're talking to someone who gives you this great pitch about how amazing life insurance is, then you ask them and they're like, they don't have a policy to show you. They can't show you their own policy performance if they're touting about rate of return, and you'd be amazed, because obviously I'm in the industry, there's a lot of folks that they're all talk. They don't know. They don't know the specific how a life insurance policy is actually structured, designed, like how the costs are broken down, how there are guarantees that are really just they're not guarantees for the life of the contract. They're just basically the current rate that's guaranteed for this year. It can change. There are a lot of moving parts. I'm obviously in the industry, so I'm very selective, and I'm very selective obviously for my clients, and everything we do, it's not cookie cutter. It's got to be personalized to that person's financial plan, and obviously a lot of it has to do with their goals and what they want to accomplish. So that's really, really important. And different states have different products too. So life insurance have really evolved to include like disability insurance as a rider built into it. There's long-term care that's built into it. There's like lifetime income. They have critical illness built into it. They have chronic illness. So if you have any of those conditions, the policy pays out too from the death benefit. So there's many designs there, but I think to start off is you got to figure which ones would you want to go with. I always strongly recommend for most of my clients starting off, my younger client that just got a med school or whatever, they're starting their career or starting a family, is get term. Term is extremely affordable. I know there's insurance salespeople out there that really promote the permanent type policies where it builds cash value. And they basically pitch you on the fact that like, oh, instead of renting, you can buy and own something that has cash value, et cetera, blah, 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 blah. But really, in reality, that type of product is very expensive. The fees and costs are really high. So the internal rate of returns of those products, if you consider it as like an investment, if you can compare it to an investment, it's terrible. It's absolutely really bad. That's why folks that sell those and offer those, they never give you an illustration with a page that's what's called the internal rate of return report. They would never include it. If you want to see how honest they are and they're pitching to you as an investment, ask them to, when they send you the illustration, let's see if they include it, because like in the state of California, it's not required. Unless that's changed, I don't know about, but last time I checked, it's not required. So they give you all these hypothetical and it's all assumptions anyway. So they have to assume that the cash value has to earn a certain rate but even then, the internal rate of return report will compare it as if you were to invest your money, what would that be like? And you realize the rate of return it's sad, it's like negative. You're better off, that's why there's this idea that came about a long time ago where you buy term instead of buying a permanent policy where you pay for the cost of insurance and then there's the cash value side. So of your $100 that you pay, let's say $55 would go towards your cost of insurance and then the $45 would go towards the cash value side that grows like an investment, but it technically is not an investment product. So that portion, that $45 would grow over time. But again, there's a lot of fees built into it. So instead of going that route, they're saying just buy a term policy, how it's insurance for insurance, and then instead of the same $100, you would invest that yourself because there's not all these extra fees that your return would be more. Generally, that is the case. And a lot of the assessments or analyses I've done for my client, that is the case. So again, you have to be very thorough in working with professionals to break down these things for you. But be assured, if you're starting off, get term. So you have life insurance, right? But if you're making that life insurance product to something more complicated, then you go with the cash value policy, which I don't recommend. Because really when you're starting off, you have a lot of financial decisions to make and responsibilities, I guess you can call it. A lot of things are new to you. But what's hard to argue is that you need life insurance and buy a 20-year, 30-year, or 35-year term. And I don't know if they have 40-year terms anymore, but I think they used to. The terms that I offer to my clients are 35-year. That's the longest term. And generally, what I recommend when it comes to term insurance, look at the term insurance this is what I have for myself. So I have term insurance as well, but that term insurance includes critical, chronic, and terminal illness. So if I have a heart attack, stroke, cancer, paralysis, if I have a long-term care type of condition, I can pull from the death benefit. So it offers me more protection than just me betting on me dying. If I die, then they'll pay me. And then it also has a condition in there for terminal illness. So if I'm terminally ill where the doctor says I have 6 months to live, I have 12 months to live or whatever, I can accelerate from the death benefit. Not all of it, of course, but a big portion to advance for me to use, right? So I think the terminal illness are generally from 6 months all the way to 2 years. Mine is all the way to 24 months, which is really nice coverage. And on the subject of life insurance, I have over $12 million of life insurance coverage combined, total. Because the reason why I've gotten so much is, one, life insurance is always cheaper when we're younger. So I want to lock in as much life insurance as I can easily afford, comfortably afford, without stressing my finances. And I want to make sure that I want to spend a lot of my wealth. So when I die, and by the way, it's a matter of when, not if. And so when I do pass away, I want to make sure that the reason why I have a lot of life insurance is I want to spend at least $12 million of my money. So when I die, guess what? There's $12 million left for the kids. So they don't, and for my family and spouse, they don't have to worry. Insurance products serves a role. I guess what I'm saying is really do your research, put in your critical, thinking hat and review and make comparisons, right? How do you know something is good? Of course, the agent will tell you that's the best, but they get paid to do that. Again, it's up to you to do your research for you and your family. So there you go. With that, I wish you all the best, and I'll see you in the next video. Please like, subscribe, and thank you.